Welcome back to discuss investment banking. Today, we'll be looking at module 3, how and where to invest in global markets. So this module explains how investors participate in global financial markets, focusing on where investors' opportunities are located, how they are assessed, and how strategies must adapt across different countries and regulatory environment. By the end of this module, students should be able to understand how investment strategies differ across jurisdiction, explain regulatory and market access requirements, identify where financial instruments are assessed globally, understand brokerage and digital platforms, analyze global diversification and risk, develop structured global investment strategies. By way of introduction, investing is no longer limited to local markets. Technology and globalization have made it possible for investors to access global opportunities across different countries. However, access alone is not enough. Investors must understand how markets operate, the rules governing them, and the risk involved in cross-border investing. Let's look at the first thing here, which is global investing complexity. Global investing introduces additional complexities such as, like I said earlier, regulatory differences. 2, currency fluctuations. 3, geopolitical risk. 4, market accessibility constraints. These factors require investors to move beyond basic knowledge and develop structured approaches to investing. Let's look at some of the strategies to be carried out across jurisdiction. They may vary depending on the country or the region. Each jurisdiction has its own legal framework. Like in Nigeria, we have our own rules guiding trading. In the US, they have their own trading guiding, their own laws guiding trading. In Canada, so on and so forth. And investors assess rules, meaning strategies must be adapted rather than applied universally. Let's look at regulatory environment. Financial markets are governed by regulations designed to ensure transparency and stability. In developed markets, regulations are strict and comprehensive, while in emerging markets, they are evolving but still important for market order. Let's look at regulatory compliance. I've looked at the environment, let's look at the compliance. What must investor comply with? 1, they must comply with account verification requirements. They must comply with tax reporting obligations. They must comply with anti-money laundering regulations. What will happen if they don't comply? Failure to comply can lead to restrictions or penalty on your trading account. Now let's look at market accessibility. Not all markets are equally accessible. So markets are open to international investors while others are closed. That is, they impose restrictions such as capital controls or special approval requirements. Let's look at trading mechanisms. Trading systems differ across markets. Developed markets offer fast electronic trading and high liquidity, while developing markets may have slower execution and lower liquidity. How do you go about investing in Nigeria? What is the structure? In Nigeria, equities are traded on the Nigeria Stock Exchange, known as the Nigerian Exchange Group. Bonds and treasury are accessed via FMDQ and banks. So if you want to buy a bond and a treasury, you go to FMDQ. Mutual funds are provided by asset managers. I already explained what a mutual fund is. So investors typically use banks, brokers, and investment firms in Nigeria. What about investor in Africa? Now in Ghana, Kenya, and South Africa, if you are looking at Ghana, is the Ghana Stock Exchange. It supports equities. For Kenya, you have the Nairobi Security Exchange, which provides access to East African markets. For South Africa, you have Johannesburg Stock Exchange, which provides advanced and liquid markets. This provides regional investment opportunities. Let's look at investing in developed markets. In the US, UK, and EU, we have the Lagos, the New York Stock Exchange, and NASDAQ DQ provide equity access, while the London Stock Exchange supports global listing. Euronext integrates multiple European markets. These markets offer high liquidity and global access. Let's look at investing in other global markets. We have China, we have Canada, we have Australia. China has controlled access market. I mean, it's not open to everybody. Canada provides sector focused investment, while Australia provides strong commodity linked opportunities. Overall, access often requires international brokerage services. Now, how do you assess global markets now? Now we have looked at the various kind of markets. Investors access the global market through structured systems involving intermediaries such as banks, brokers, asset managers. Regulatory compliance, comply with the legal rules, and financial infrastructure. Direct access is rare. Most participation occurs through established channels. That's where investment banking comes in. Let's look at brokerage. Brokerage firms connect investors to global markets. They provide trading access, execution services, and portfolio tools, enabling investors to trade across multiple jurisdictions. Let's look at institutional access. Institutional investors use advanced channels such as investment banks, custodial systems, cross-border clearing networks. These allow access to large scale and exclusive investment opportunities. Let's look at digital investment platforms. Technology has made global investing more accessible. Digital platforms allow investors to trade international assets, track portfolio, and access multiple markets from a single interface. Let's look at liquidity in global market. Liquidity, like I said before, determines how assets can easily be traded. Higher liquid market allow quick entry and exit, while less liquid makes markets or means that markets may present challenges in execution and pricing. Volatility and risk, I already explained before. But under global investing, there are kind of different kind of risk. We have market volatility, we have credit risk, we have currency risk, we have geopolitical risk. Now, this risk must be carefully evaluated when investing. Now, let's look at diversification across various countries. That's the essence of this module. Global diversification will help reduce dependency on a single economy. So you will not just put your hope in one economy like Nigeria or the US or Canada. You have in various economies. By investing across regions, investors can balance risk and improve portfolio stability. Let's look at currency risk properly. This is when there's currency fluctuations and it will affect return or it may affect return. Even profitable investments can lose value if exchange rates moves unfavorably, making currency management critical. We have looked at portfolio allocation before. Now, global portfolios must balance the asset classes, the regions, the risk level. Allocation decisions depend on investors' goal, time horizon, and risk tolerance. Now, let's look at building global portfolio. A strong global portfolio includes one, multiple regions, two, mix of developed and emerging markets, three, combination of asset classes. This is a balanced portfolio. This creates resilience and long-term growth potential. Now, let's look at some of the limitations or problems in global investing. They include one, complex regulations, higher transaction cost, difficulty in monitoring global markets. Diversification will help you reduce risk, but it does not eliminate it. By way of conclusion, this module explains how investors navigate global markets assess financial instruments, and manage cross-border risk. Successful investing requires understanding both market risk and risk management in a global context. At the end of this module, there's an assessment session where part A is quiz and part B is a report, a written report to help you better understand this module. I'll see you in module 4.